This is Tim Phillips, CEO at Phillips and Company Advisors. Thank you for reviewing our Q4 2022 look ahead. Please review the disclaimer carefully. During the middle of this difficult market pullback, as investors, it's easy to lose perspective on where we are in the economic cycle. We're in the early stages of a negative consumption cycle where consumers will grow sour on rapidly rising interest rates and inflation, and they'll pull back on spending. Now, you might be questioning, how long will all of this last? The chart on the upper right suggests we've paid the price, peak to trough, with a drawdown of over 20% already, and recovery could be in 10 months if this is a cyclical sell-off, which it looks like for now. Historically, if we've had year-to-date declines of 10% or more, the next 4 quarters are strong for returns, with an average of 27% in election years. The Fed is the monetary catalyst to the sell-off, of course driven by inflation, which we'll address in a later slide. With the third 75 basis point lift in rates, the Fed is on course to move the terminal Fed funds rate to about 4.25% by year end and perhaps 4.75% in early 2023. 3 more rate hikes as of now. If you look at the lower left chart, you can see the Fed reverses course quickly with an average of 6 months between the last rate hike and first rate cut. In our case, that might put us in the rate cutting territory by mid-2023. Wall Street estimates approximate that time frame in the upper right-hand corner. The object of the Fed is to punish the consumer into some kind of consumption submission. Mission accomplished at the front end, for sure. Mortgage rates are at pre-financial crisis highs. Both auto and existing home sales are dropping rapidly. And 16.32 trillion, or nearly 67% of GDP, has been wiped out of stock market wealth. And we're clearly on the precipice of a U.S. recession. It's a scary picture that is reflected in stock and bond prices, and most definitely in current portfolio values. Here's the good news, or perhaps the bad news. The consumer is in amazing shape, with jobs plentiful and wages at historic levels. The consumer is sitting on nearly $2 trillion in surplus savings, and that's about 8% of GDP. Consumer spending has been on the rise in spite of negative consumer sentiment. And the S&P 500 earnings are still strong but abating, and we should see a drop in employment as corporate earnings contract. So the good news is a soft economic landing by the Fed is still in play with the strong consumer. The bad news is it'll likely take the full measure of the Fed to raise rates as high as 4.65% or 3 more times to put a chokehold on the consumer if that's what's really driving inflation. So here's the broken record on inflation. It's still at record highs, but much of current inflation is still being driven by ongoing supply chain issues. Those issues, especially transportation, are moderating, and we still hold out some hope this moderation will put a ceiling on the Fed's demand destruction mode sooner than Q1 2023. If the month-over-month change in CPI stays on the pace it's at 0.1%, we're at now, we could see inflation back down below 2% by June of next year. Coincidentally, that's pretty close to the historical pattern we've seen on page 1 of this presentation as it relates to market recoveries. For our typical investors, you've gone through an unprecedented time when your fixed income investments are highly correlated to your equity investments. That's produced a historically bad year for balanced portfolios. It has certainly made us question the active managers in fixed income. However, there's been nowhere to hide other than cash. And the upper right chart shows the historic levels of cash. So where will that cash land? Back in fixed income at higher yields, or will it chase equities? It's impossible to know, but one thing to keep in mind is with a little longer duration on fixed income, the returns can look pretty good during rate cut cycles, which we hope we get into mid next year. We do have some time to evaluate this as we weave our way through a hopeful end of this rate increase cycle in the coming months. Let's put aside the discussion on interest rate cycles for a moment and take a look at what really drives long-term equity returns. That's earnings. Earnings are being revised down for both Q3 and Q4, and that's probably part of the catalyst for poor equity performance. However, we're still in positive earnings territory, and that's not bad coming off a blockbuster 2021, which reflected pandemic spending and excess stimulus. Now, one tailwind in the coming year, this year, is nearly $1 trillion of stock buybacks that boost earnings per share. We should see that play out in the coming quarter. Another positive catalyst is the S&P 500 valuations are below the 10-year averages. That too should draw some of that cash we just spoke about back into equities in the near future. Developed market earnings are still limping along with modest growth, but those forecasts are hopeful at best. While valuations are well below their 10-year averages and at a big discount to U.S. equities, GDP growth will likely slip into recessionary territory in the months to come, especially with energy and food constraints driven by the Ukrainian war and excess debt financing in Europe. Emerging markets have taken a large hit due to strong U.S. dollar impacting credit financing and China's zero COVID policy impacting overall emerging markets performance. Similar to developed markets, they too are trading at well below 10-year averages and at a steep discount to U.S. equities. The big difference between EM and developed markets are the macro backdrop. GDP growth levels are still expected to be much higher than the U.S. levels and developed market levels. In fact, Vietnam posted historically high GDP growth rates at over 7%. Speaking of emerging markets, China's been the main drawdown. Whether you're invested directly in China through an emerging markets manager or both, you've been impacted similar to U.S. equities. China's markets heavily dependent on their domestic retail investors, and those investors have been marshaling cash due to the draconian zero COVID policy. While daily activity indicators are working their way back to normal, the investment environment will be difficult and a transition out of zero COVID is possible. One catalyst be the weakening currency relative to the US dollar. China cannot continue indefinitely propping up their currency and will need to open up their economy to allow for a more stable currency. That just might be the catalyst needed to push the Communist Party to phase out zero COVID. So let's return to how we started this discussion. How long will all this last? Forecasts are what they are, just guideposts. However, if you look across this deck and this particular slide, we've posted some of those guideposts. I won't review them all, other than to say they all suggest strong recoveries once we get back on track past the recession and negative GDP quarters. The key to all this is to be disciplined and not to try and time the markets. As you can see in the bottom diagram, if you just miss a very few number of days, you get your returns crushed. Rebalance? For sure. Dollar cost average? Absolutely. Tax harvesting? Great idea. Timing? 100% don't do it, and don't listen to anybody that tells you they can. You can read a summary of our views here and our recommendations that summarizes our entire presentation. Really, though, what's on our mind is, are we in the middle of a secular regime change from low inflation to high inflation, low interest rates to permanently higher rates, globalization to deglobalization, carbon-driven energy to carbonless economies, and uncorrelated stock and bond movements to correlated stock and bond movements? It's far too early for us to make any conclusion or dramatic moves. I've highlighted a few on the right-hand side, and we want you to know we are thinking about those big changes that could occur in our macro investment environment. Our mean reversion dashboard suggests a few areas to look at for better value. Certainly large, mid, small value, as well as blend, looks pretty reasonable. Emerging markets, developed markets, still look reasonable. Places like China and Brazil look very cheap. Areas like energy, real estate, materials, telecom all look to be fairly valued. Thank you for taking your time to review our Q4 2022 look ahead. If you have any questions, you can email me at the email address below. And of course, please reach out to your advisor with any questions about this presentation, your plan, or your portfolio performance.